Welcome to the Financial Flossing Podcast with Ross Brannon, guiding dental professionals to a brighter future. Ross Brannon is a financial advisor who knows it's not just about your teeth. He helps dental practice owners protect and maximize today's cash flow to plan for tomorrow's cash needs. Find him at rossbrannon.com. On the show, he brings together experts to help dental professionals looking to make smart money decisions to grow their income, turn their retirement goals into reality, and improve their lives. And now, here's your host, Ross Brannon.
Welcome to the show. My guest today is Stan Kinder. Stan Kinder owns Everything DSO. He is a DSO insider and consultant for dental practice owners who want to have maximum impact and profitability in their field. Stan helps dental practices, both well-established and new, grow their income and navigate a playing field full of huge DSOs, and has worked out tons of great deals between dentists and DSOs that leave everyone satisfied. Stan Kinder, welcome to the show.
Thanks so much, Russ. I really appreciate the opportunity.
All right, so let's jump right in. For those who don't know, what is a DSO?
A dental service organization. Essentially, these are predominantly private equity funded entities that consolidate individual dental practices under the umbrella of a larger organization with a view towards bringing economies of scale, other resources to the table to help their constituent practices accelerate their growth and profitability.
Okay, so they're buying up dental practices everywhere, correct?
Absolutely.
Why are they doing that?
The one word, I think, answer is yield. Private equity for many years has generally had an interest in consolidating what are typically described as sort of cottage industries made up of large numbers of small businesses, aggregating them together with a view towards improving profitability.
Okay, now, as we talk about them chasing yield, would it be fair to say that if we weren't in a low interest to zero interest rate environment that we've been in for the past 10, 12 years, that they wouldn't be going after dental practices? Or do you think that matters?
I think that they would probably still be going after, but it makes their ultimate economics more favorable. Private equity typically uses their equity dollars, leverages that with debt, which generates a higher rate of return on their equity. So given that debt is very low cost to almost no cost in today's world, they're able to generate generally more powerful economic leverage, which gives them a better yield in the final analysis.
Okay, so some have called you the DSO whisperer. How did you become the DSO whisperer?
Well, I embrace that description enthusiastically. It's largely as a result of my having spent almost 15 years with 3 different DSOs, and generally in senior management roles, typically being primarily responsible for mergers and acquisition activity, in one instance in a senior operating role. So I have spent the bulk of my time basically in conversation with dentists interested in exploring a relationship with DSOs.
Okay, so I have one accountant in the dental space who tells me, in his opinion, 5 years from now, 75% of all dental practices will be DSOs. Do you agree with that? Is that an accurate statement? How long will this trend go?
Yeah, there's been a lot of speculation in the trade press that says over the course of the next 3 to 5 years that the expectation is that number will grow to 60 to 65% of all dental practices. And right now, today, it's roughly 20 to 22% and is growing at an ever accelerating pace, largely as a consequence of a lot of small to mid-size group practice owners have seen the highly favorable economics that come with an eventual affiliation or sale with a DSO and or directly with a private equity firm.
Wow, that's interesting. So you don't see this trend slowing anytime soon?
No, not at all. I can tell you the last company that I was associated with was Dental Care Alliance. They're considered one of what's frequently described as an enterprise DSO. So that descriptor tends to refer to the largest and to some degree the longest standing DSOs in the market. And Dental Care Alliance had a little north of 300 practices and was approaching $1 billion in patient revenues under management.
Wow.
So when you think of 300 plus practices as a percentage of the total practices out there, that it's kind of 0.0001% or less. And so the runway for additional growth is almost unlimited.
So could it ever come to a point where a dental school graduate could not start their own practice? I don't see how they could prevent you from that. But would the market ever be a place where it's only employee dentists versus business owner dentists?
Well, I think that there will always be room for private practices, in my judgment. I just think the challenge of A, both establishing and B, operating on a sustained basis over an extended period of time is going to become increasingly difficult for a number of reasons. One, in 2019, the American Dental Education Association said the average dental school graduate came out of dental school with a little over $284,000 in educational debt. So huge debt burden. So those folks have a tendency to be more interested in a job where they can service their debt, earn a living income, and grow and develop as a practitioner, as opposed to taking on the additional debt necessary to either acquire or start their own practice. Another factor in the mix is currently a little over 50% of graduating dental school classes are female, and statistically, female dentists have a higher level of interest in working part-time. Not always the case, and there's certainly many successful female dentists, but on average, the probability is that they're less likely to become practice owners than their male counterparts.
Makes sense. Okay, so speaking of kind of what you were saying there, one of the things on your website, the phrase "adapt or die" shows up a lot.
Sure.
And so, from your perspective, what does this mean for dentists? Like, what do they have to adapt to, and what are the stakes?
Well, I think independent of where any individual dentist is today in terms of how they think about a DSO or a potential relationship with a DSO, DSOs are having an ever-growing impact on the profession. And from my perspective, it's important that they both understand the particular challenges of remaining independent, and two, understand sort of what are the economics and the drivers that potentially make a DSO make sense, whether as an employed associate dentist or potentially as an owner of a practice liquidating their own equity interest and affiliating with a DSO.
Oh, wow. So have you seen a practice fail to adapt? And if so, what mistakes did they make?
Certainly, I think, every dentist in practice has heard a story of a colleague or a peer who has struggled in one way, shape, or form. I won't necessarily attribute that directly to the growth of DSOs, but DSOs bring an incredible amount of resource to the table. Generally, they've got access to capital. They've got highly trained and professional staff to deal with all of the non-clinical things that an individual practice owner, him or herself, has to deal with. So that, whether it's negotiating with a supplier, negotiating with a PPO, how to structure employment arrangements for staff or associate dentist, There's almost an infinite number of things that they can help them do cheaper and more efficiently. And so as the solo practitioner confronts those challenges and increasingly has to deal with that burden, their colleagues in the DSO universe are going to be moving at a faster pace, in my judgment, over time.
So when we talk about DSOs, we should talk about valuations.
Sure.
So there's a lot of buzzwords thrown around here. You hear the word top line revenue, you hear the word EBITDA, and it's so funny. EBITDA, earnings before interest, taxes, depreciation, amortization, is it's an accounting term, but 5 people can come up with 5 different EBITDAs, which I find quite fascinating. So talk a little bit about the metrics. Talk a little bit about, what is taken into account in valuing a practice. For example, one thing I've heard, if you're really good with systems and you have good systems in place, that can drastically affect your valuation in a positive manner. Talk about that for a minute.
Sure. First, let me speak to kind of what I would call the macro differences between traditional valuation approaches and how DSOs approach valuation. Historically, practices that have been sold from one dentist to another dentist have transacted for, on average, between 60 to 80% of their gross revenue. And the primary reason for this is that historically has been the limit to what a bank would lend for to the dentist who's buying a practice. And almost 100% of practice purchases historically were bank financed. And so valuations have tended to operate inside of those parameters. Not 100% of the time and not absolutely, but for the vast majority, that would be the case. And DSOs, on the other hand, value the practice based on the EBITDA term that you used, which is an accounting measure of the free cash flow that a practice generates. And where DSOs essentially contribute to the private equity firms making their money is the DSOs acquire their practices essentially at what I would describe as a wholesale price. And eventually, when they exit the DSO, they do it at a retail price. So a practice as a standalone entity has a value of X today. The moment it becomes part of a DSO and a large integrated group, that value goes to X plus, 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 plus.
So are you saying that I sell my practice? We were talking before we went on air about a practice that's going to sell for $11 million. So this practice for this dentist might sell his practice for $11 million. I think to most people, they would consider that a very large number and a very good valuation, all things considered. You're telling me that when the DSO buys that for $11 million, they actually feel like they're buying that at wholesale because they can kind of fix and flip, if you will, to use the house term, fix and flip, create the efficiencies, and then sell it or sell a package of these practices to somebody else, whether it's a bigger DSO or private equity group, at a higher price retail-wise.
That's exactly correct. Private equity basically is nothing more than the aggregation of money that gets invested with a view towards generating a favorable economic return. The investors in private equity funds are typically pension funds, endowments, high net worth individuals. So when a private equity fund invests in a particular company, they usually have a target holding period of somewhere between 5 and 7 years before then they would look to do what's called a recapitalization, which is essentially a big word that means sell. And most commonly, they're selling to a larger private equity fund who has the capital to continue to fund their continued growth over time.
So the larger PE firms let the smaller PE firms go out and do the dirty work, the legwork, and they just come and buy them up later.
Yeah, exactly. So that's a pretty apt description. And the DSOs are generally acquiring practices in today's world somewhere between a 4.5 to as high as maybe 7, sometimes even 8 multiple, which means whatever the EBITDA is, they're paying 4.5 to 8 times that number. And right now, when they exit, they're generally getting 11.5 to 14 times.
Okay, so 4.5 to 8. It's a pretty large spread. Most people would prefer 8 over 4.5. What's the difference in 8 in a practice that gets 8 versus a practice that gets 4.5?
Most commonly, it tends to be the scale of the EBITDA. So a practice that generates $400,000 in EBITDA is going to be at the lower end of that range. A practice that generates, or group that generates, say, $1.5 million in EBITDA is going to be at the upper end of that range. So it's really a function of the cost to the DSO and the private equity firm of consummating a transaction is pretty constant from the $400K EBITDA practice to the $1.5 million EBITDA practice. So there's a lot of efficiency gain for them in doing those larger deals.
So I've talked to some dentists who say they hate corporate dentistry and they would never sell to a corporate dentistry outfit, a DSO. What's your response to that?
I really think that that's misguided conclusions. I mean, when DSOs first arrived on the scene, organized dentistry was very anti-DSO for a lot of reasons. And one of the biggest was the notion that if a corporation is involved, then you're going to have non-clinicians influencing the care that patients ultimately receive. And what I will tell you is almost every state in the country has restrictions on the corporate practice of dentistry. So all of the DSOs draw a very bright line between the administrative and business services that they provide and the clinical decision-making that occurs. As the clinical decision-making generally resides with whomever the chief dentist is in the practice. And if a DSO was to sort of cross that boundary, they would very quickly be sanctioned by state boards. And so they're very, very careful about that separation.
So let's talk a minute about who you typically work with. Your website says your target client is at least $1 million in revenue, and not every dentist knows their EBITDA, so we'll use top line revenue as a discussion point here. Looking to grow, that's kind of the baseline for you, the minimum $1 million in revenue looking to grow. Who is your typical client? Who should be saying, I need to talk to Stan Kinder?
Sure. What I will tell you is the practices that are most attractive to DSOs typically tend to be more than a single provider. And part of the reason for that is it mitigates the risk to the DSO. Most dentists will tell you, and I agree with this, is the number one way to take a practice backwards is to have provider turnover. And so if it's a multi-provider office, if for some reason one provider is sick or disabled for some period of time, or there's some turnover with one of the clinicians, there are other clinicians that continue to keep the engine running. And so that's attractive. So I tend to work more predominantly with dentists who have larger practices as a consequence of there being more than one clinician. But that's not true in absolute terms. I also certainly have worked with any number of solo providers as well.
And do you really have to have $1 million of top line revenue to really even go down the road of selling?
It depends. DSOs have different profiles in terms of the kind of practice that they're most interested in affiliating with. Heartland, which is the biggest DSO in the country for some time, very, very well north of $1 billion in top line revenue and more than 1,000 practices affiliated. has a very significant number of solo practitioners in their portfolio. So on the other hand, Dental Care Alliance, the company I was with, the vast majority of their affiliated practices are larger and multi-practitioner. It really depends a little bit.
Now, when a dentist sells, actually, let me step back here and ask this question. The majority of DSOs are buying general dentists and orthodontists, correct?
Yeah, more consistently, although there have been a growth fairly significantly over the course of the last couple of years, solo specialty focused DSOs.
So like the perios or the endos,
Yep,
those people?
Exactly. And what I would tell you is most of the larger DSOs will look at specialty practices in their mix, particularly in markets where they've got a reasonably high density of affiliated general practices, because it sort of lets them create a little bit of a hub and spoke kind of relationship between the general practices and the specialty practices.
Okay, so now if I sell my practice to a DSO, they're not necessarily taking down Ross Brannon dentistry on the side and putting up Heartland, are they? Many times the patient many times doesn't even know there's been a change, correct?
Absolutely. The most common type of DSO is what they call acquisition-driven DSOs, and they acquire existing practices and largely operate those practices with precisely the same identity they've had historically in terms of how they face the patient public. And nobody would ever even be aware that they're affiliated with a DSO. There are a handful of what's called branded DSOs, probably the most notable being Aspen, which is the second largest DSO in the country. And all of the Aspen affiliated practices are, in fact, Aspen.
Yeah, now Aspen's a little bit different model, isn't it? Because they let their dentists it's almost like a franchise model, isn't it? What Aspen does?
Yeah, a little bit. How I would describe it is it's almost a retail model. Aspen does very heavy direct-to-consumer marketing when they open a practice and look to drive patient traffic into the office. And it's a little bit like the Gap or any other retail store. They go and look for locations that they believe will be successful. They open a store and then sort of use their operating model, which has been proven in many, many locations to drive that particular practice. I talked to the chief real estate guy from Aspen some years ago, and he said, basically we look for a relatively new strip shopping center that has a Walmart, a Panera Bread, and a Verizon store. And if those three things all coexist, we know we've got a winning location.
Wow. Now, don't they sometimes sell their practices to the dentist, but it's like a franchise model?
Yeah, absolutely. Essentially, the dentist agrees to use the Aspen management services. The dentist owns the practice and then contracts with Aspen to provide all of the back office support. And the dentist agrees to sort of operate in a way that's consistent with the Aspen umbrella. And very often, their dentists in their new locations are senior associates from an existing location who have expressed an interest in becoming owners. And so they will move them into a new location and set them up.
So how does Everything DSO, how do you help clients? How do you help them navigate this world of DSO?
Sure. Well, I've got relationships, given my time in the industry, with a significant number of DSOs. And I am what is commonly referred to as a buy-side broker as opposed to a sell-side broker. Sell-side brokers essentially charge the seller a commission for whatever assistance or support they provide through the process. A buy-side broker is compensated by the buyer if there's a closing transaction. So there's
let's stop right there, because I've had some interactions with people on this. I've seen, because everyone assumes like a real estate broker, the seller pays the commission. So it's called 5-6%, whatever. You sell $1 million house, it's 5 or 6% paid by the seller. I've seen DSO brokers have the seller pay the commission. But what you're saying here is that the DSO actually typically pays the commission. So if you're a seller paying the commission, there's something wrong in that scenario. Is that right?
Not necessarily wrong, but certainly at a very significant cost to the seller. Sell-side brokers are typically charging anywhere from 7, 8, 9%. So on a multi-million-dollar transaction,
on a $10 million transaction, that's $750,000.
Yeah, that can be a substantial amount of money.
Now, do some brokers, if their sellers are not really hip to the game, do they double dip and get it from both sides?
I can't say that I've witnessed that firsthand, but I would not be at all surprised.
So it's in the dentist's best interest to work with a buy-side broker.
It's certainly in their economic interest. Now, what I will tell you is the reservation that's most commonly expressed is, well, are you going to be working for me or are you going to be working for the buyer? How do I know you're going to get me the best deal possible? And what I will tell you is fundamentally, almost 100% of the letters of intent are what they call non-binding in absolute terms, which means that the seller has the ability to walk away from the transaction anytime up until the closing. So if they're not happy with the deal, they can walk away. And what I tell people fundamentally is, if I don't bring you a deal that makes you happy, there's no deal. And by the same token, if I'm not bringing a deal to the buyer that makes them happy, there's no deal. So I'm sort of obligated, in order to be successful in my own interest, to keep both parties happy. The other thing I will tell you is private equity has used buy-side brokers for years and years and years in other businesses. And one of the primary reasons is that commission cost is what's called below the line, which means it's capitalizable to them and doesn't affect their EBITDA or P&L on a current basis. So it's kind of zero net cost to them in the near term. And because it's deductible, they're able to recapture that cost. And so it doesn't affect the ultimate enterprise value that they're prepared to offer a dentist in a given situation.
Okay. And so we kind of got off topic there. So how do you help the clients besides representing them? You're leveraging your contacts for having multiple decades in the industry. What do you do for your clients?
It begins with a conversation where I basically help them to articulate what their specific goals and objectives are. What is it that you really most want to achieve? Then I'll do a detailed valuation analysis of the practice to help them understand sort of what's the range of possibilities here in terms of eventual outcomes, and to see whether or not that sort of fits inside that articulated goal and objective. And I have also, in some instances where a practice perhaps wasn't at the level of profitability that it should or could be, sort of help them to understand where the opportunities were for them to remedy that over time.
Now, is it a tough sell for clients to realize they need you?
I would say that dentists are increasingly, because they're generally not experienced at selling a practice, whether it's to another dentist or to a DSO. And so they sort of come to the table with a little bit of a knowledge gap, if you will. One of the things I have told people, part of what has driven me to pursue the buy-side brokerage proposition is that part of my goal is to help address what I call information asymmetry. Generally, when a dentist is negotiating with a DSO, the people on the other side of the table are super highly sophisticated. they buy and sell businesses all day, every day. And, the dentist comes to the table, and while they may be reasonably good business people and very capable clinicians, they're not particularly adept at buying and selling a business. And so if I can help them gain the knowledge to become more adept, I see that as a good thing.
Do you find some of them think they're more sophisticated than they are?
Without question. And increasingly over time, people have heard kind of these big numbers in terms of multiple. And so they come to the initial conversation not uncommonly with fairly unreasonable expectations as to what their practice might be worth. And so, part of the exercise is helping them understand, look, here's what's reasonable given the marketplace today.
So if a client wants to settle a DSO, what's a critical thing for them to keep in mind as they enter negotiations and want to get the best deal?
I think a couple of things is practice is an asset like any other asset. And so, the better the condition of the asset, the more you're going to be able to negotiate for better pricing ultimately. And so that addresses everything from the quality of the infrastructure, the facility, the equipment, whether or not it's a practice that's growing or whether it's flatlining or declining, how well the records are organized. The better the organization, the more appealing it is to the DSO, because it means that they don't have to create that organization themselves. It's already pre-exists to some degree.
So you spoke about this a minute ago, but what financial savvy do you wish you saw out of more dentists?
I think, the average dentist basically thinks of their practice as their profession and a job. And it certainly is those things, but it's also a business. And so I wish the dentists could think about their practices more in the context of a business, just like if they owned a retail business or a distribution business or any kind of business. And so that they had the ability to sort of step back and look at the business and focus on the strengths and weaknesses and how to increase the profitability, as opposed to kind of just, this is where I do the dentistry that I do, and spend 100% of their time focused on being clinicians and 0% of the time on being business owners, if that makes sense.
Well, that's kind of what I've seen. I've seen you've got the lower revenue dental practices are dentists who basically own a job, and the higher revenue practices are the owner is a business owner. He just happens to be a dentist.
Yep, exactly. And, the dentists that I have known over many, many years of working with dentists, and I've owned practices indirectly in partnership with dentists in the past. I've consulted with a significant number of practices, and obviously have been involved in the DSO world for some period of time. The dentists who really reach outside of themselves and look to get expert help tend to operate at a much higher level than those who don't.
Right. All right, so let's change gears here as we wrap things up. I always ask a handful of questions to everyone on the guest, every guest I have. What's the best piece of advice, financial or non-financial, that you've ever received?
I would say just understand that you're responsible for everything that happens in your life, good or bad. That, you can blame other people for the negative outcomes of the bad things that happen, but that's not going to change anything. And other people aren't going to get you to a better place. Only you can get you to a better place.
That's great wisdom right there. What are you reading, or what's your favorite book?
I am a huge fan of anything and everything written by a guy named Dan Kennedy.
Oh, yes.
He's a marketing guru, and frankly, in my mind, a genius. And I read everything the guy writes. I subscribe to their newsletter, have been for many years, even though it's fairly expensive as newsletters go, but it's worth every penny. The guy is really brilliant. And if a dentist is really interested in sort of understanding marketing at a higher level, they would do well to read Dan Kennedy.
And what do you wish, or what advice would you give a brand new dental school graduate?
I think to strike an appropriate balance between the development of their clinical skills as well as their business knowledge. You see all too often the focus is almost exclusively on the clinical skills. And I've known a lot of guys that have basically attended hundreds of hours of clinical CE and ultimately are failing in their practices. And I say to dentists all the time, I've known very average dentists who had exceptional levels of success because they knew how to communicate with people and focused on some of the non-clinical things. And I've known people who were exceptional clinicians that I would go to, I would refer my mother, my family to, but who couldn't succeed because they couldn't master the non-clinical things.
It's funny how that works. It is funny how that works. So, well, Stan Kinder, it has been fascinating speaking with you today and enlightening our listeners on the world of DSOs. And if people want to get in touch with you, what's the best way to get in touch with you?
My cell phone is 703-298-1690. My website is www.everythingdso.com. And my email address is stan@everythingdso.com. And an offer that I would like to make to all your listeners, Ross, is I have written a book on DSOs that's fairly comprehensive. And I'd be more than happy to provide a free PDF copy to any of your listeners that would be interested. And all they need to do is reach out to me in any of those three methods, and I'll be happy to get it in their hands as quickly as I can.
That's great. I appreciate you doing that. So once again, Stan, thank you so much for your time today. It was absolutely enlightening what you share with us. And you've been listening to the Financial Flossing Podcast with Ross Brannon, and we'll see you next time.
This has been another episode of Financial Flossing with Ross Brannon, guiding dental professionals to a brighter future. If you liked what you heard, consider subscribing wherever you listen to podcasts. For more on Ross Brannon, visit rossbrannon.com.
Registered representative and financial advisor of Park Avenue Securities, LLC, PAS, OSJ 3664 Coolidge Court, Tallahassee, Florida 32311, 850-562-9075. Securities products and advisory services offered through PAS, member FINRA SIPC. Financial representative of the Guardian Life Insurance Company of America, Guardian, New York, New York. PAS is a wholly owned subsidiary of Guardian. North Florida Financial is not an affiliate or subsidiary of PAS or Guardian. California Insurance License Number 0L10073. Arkansas Insurance License Number 161-39032. 2021 119535. Expires 423. That last part can also say 2021 119535. Expiration April 2023.
This podcast is for informational purposes only. Guest speakers and their firms are not affiliated with or endorsed by PAS, Guardian, or North Florida Financial, and opinions stated are their own. Ross is a registered representative and financial advisor of Park Avenue Securities, LLC, PAS, OSJ 3664 Coolidge Court, Tallahassee, Florida 32311, 850-562-9075. Securities and products and advisory services offered through PAS, member FINRA, SIPC. Financial representative of the Guardian Life Insurance Company of America, Guardian, New York, New York. PAS is a wholly owned subsidiary of Guardian. North Florida Financial is not an affiliate or subsidiary of PAS or Guardian. Arkansas Insurance License Number 161-39032. California Insurance License Number 0L10073, 2021 123604, expiration 0723.